Warren Buffett is one of the 5 richest men on the planet. And he didn't get rich because he was born with money. Let me tell you this. Most people fail at investing because they complicate what should be simple. He did exactly the opposite. He got rich when he stopped following fads and started valuing stocks like real businesses. Don't follow prices. Rate companies. In this video, I'm going to tell you how he did it. I'll show you the simplest way to value a stock, just like I've been doing for decades. I'll explain it to you the way I would explain it to a 10-year-old so everyone can understand. For years, I've repeated the same phrase over and over again. Don't invest in a business you don't understand. It seems obvious, but most people ignore it. People ask me if they should invest in cryptocurrencies, biotechnology, software companies that don't make a profit, and I always give the same answer. If you can't explain how that company makes money on a napkin in less than 2 minutes, you shouldn't put a single dollar in it. His success didn't come from chasing what was trendy. It came from focusing on what he knew. Simple ideas, predictable businesses, products that people use today, tomorrow, and 10 years from now. Coca-Cola, Gillette, American Express, companies that even a child can understand. That's the foundation. Before you look at numbers, you have to understand the business. Because if you don't understand how a company makes money, how will you know if its stock is cheap or expensive? When you buy a stock, you don't think like a trader. You think as if you were buying 100% of the business, and as if you couldn't sell it for the next 20 years. Would you do that? Would you buy an entire company if you didn't understand its products, its customers, or its future? Many people buy stocks hoping they'll go up. He buys them hoping they'll pay dividends, grow their profits, and increase their real value over time. I don't care if the price drops tomorrow, as long as the business remains solid. This way, you begin to see stocks for what they really are, parts of a real company. They're not casino chips. They're part of a business. And if you wouldn't buy the whole business, then you shouldn't buy a single share. Now, how do you choose your actions then? Let me tell you about some tools that are useful and really very easy to calculate. 1. Intrinsic value and discounted cash flow. Let's start with what many people think is complicated, but it isn't: company valuation. How do I know if a stock is cheap or expensive? It all starts with a question: how much money will this company make in the future? And that brings us to the concept of intrinsic value. Intrinsic value is what a company is actually worth, not its market price, but the total value of all the future cash flows it will generate, brought to the present using a discount rate. In other words, imagine you own a bakery. Every year, that bakery nets you $100,000. And you expect it to continue that way for the next 20 years. How much would you pay for that business today? That's what we do with stocks. We use the discounted cash flow, DCF, method. We estimate how much cash flow a company will generate over the next few years and bring it forward to the present with a reasonable interest rate. That gives us a number, the true value of the business. If that value is higher than the current market price, then we have a chance. Let's analyze this in detail with an example. It involves adjusting future income to the present. Let's assume we have a discount rate of 10% per year, because that is the return we would like to earn on the investment. Following the bakery example, the annual cash flow we will receive is $100,000 for 20 years. The present value of those $100,000 annually at a 10% interest rate is approximately $851,000. That is, that bakery is worth $851,000 today. What if it's listed on the stock market for $600,000? You've got a bargain, because you'd be buying an asset worth over $850,000 for just $600,000. That's what this method is about. 2. The safety margin. But be careful. It's not enough for the stock to be slightly cheap. I don't buy a dollar by paying 95 cents. I'm looking to pay 50 cents for that same dollar. That's what's known as the margin of safety. It's that cushion that protects you if your calculations are wrong. Because we're not fortune tellers, we don't know exactly how much a company will earn in the future. But if you buy at a deep discount to its intrinsic value, you have much more room to be wrong. Let me give you a real-life example. If I estimate a company's value is $120 per share and the market is selling it for $60, then I'm interested. That gives me a 50% discount. Even if my projections are off by 20 or 30%, I'm still protected. That's why I prefer companies that are clearly undervalued. I'm not interested in a stock that's fairly valued. or slightly cheap. I want opportunities that are clearly cheap, even if that means waiting months or years for them to appear. Remember this: price is what you pay, value is what you get. And if you learn to think this way, you'll already be ahead of 90% of other investors. Before continuing with the rest of the video, if you find this information useful, I invite you to give it a like and subscribe to the channel to stay up to date with new content. 3. The PER, or price to earnings ratio. One of the most well-known and misunderstood ratios is the price to earnings ratio. Most people look at it as a magic compass, but I never take it as an absolute truth. I use it as an initial clue, never as a final judgment. The PE ratio tells you, in theory, how many years it would take to recover your investment if the company's earnings remain constant. For example, if a stock costs $50 and earns $5 per share per year, its PE ratio is 10. That means you would recover your investment in 10 years if nothing changes. But that number is only useful if the profits are real, stable, and sustainable over time. A PE of 5 in a company that's crumbling isn't a bargain. It's a trap. On the other hand, a company with a PE of 25, but that grows its profits by 20% annually with high profitability and little debt, can be a gem. Coca-Cola stock in 1988, its PE was around 15. For many, that was expensive, but he knew it had an unbeatable brand, high margins, and consistent growth. Today, decades later, that investment has returned hundreds of times what I invested. The lesson here is not to obsess over a low PE ratio. Always ask yourself why it's low. Is it an opportunity or a warning? 4. ROE, return on capital. This is another of my favorite indicators that stands for return on equity. Why? Because this ratio tells me how much profit a company generates for every dollar its shareholders contribute. I'm not interested in a company that makes a lot of money if it constantly needs to invest new capital or take on debt to do so. I'm especially interested in one that generates more with less. That's efficiency. When I see a high and sustained ROE, I know I'm looking at a company with real competitive advantages, a solid structure, and smart management. For example, when I invested in American Express, its ROE was over 25%. That means that for every dollar of capital it had, it generated at least 25 cents of profit per year, without needing to constantly increase its capital base. That says two important things. First, that the business model was solid, and second, that the brand and customer loyalty gave it an advantage that wasn't easy to replicate. When he saw that it maintained that level of profitability year after year, he understood he could rely on that long-term investment. And so he did. He has been one of its largest shareholders for more than 3 decades. Now, imagine you have two companies, both earning $1 million a year. But one does so with $10 million in capital, meaning it has a 10% ROE, and the other only earns $3 million in capital, meaning its ROE is 33%. Which would you prefer? I go with the second, since it's using the money much more efficiently. So when you analyze a stock, look at its ROE. And not just for the last year, but its performance over time. Because a company that knows how to multiply its money without asking for more capital each time tends to perform very well. 5. Debt, the double-edged sword. Now let's talk about something many investors don't take seriously: debt. I always say that debt is like a sharp sword. It can help you move forward faster, but it can also cut your head off if you don't know how to use it. One of the ratios to look at is the debt-to-equity ratio. This indicator tells me how much borrowed money the company is using in relation to its own capital. If a company has a ratio of 2 to 1, it means that for every dollar it has in its own capital, it has borrowed 2. And why do I care about that? Because debt can amplify profits in good times, but also multiply losses when bad times come. And believe me, bad times always come. When Warren invested in Moody's, one of the things he liked most was its low debt level. At the time he made the investment, its debt-to-equity ratio was below 0.7. This indicates that the company wasn't overly reliant on borrowing for growth. It had a strong business model, high margins, and little need for additional capital. So when analyzing a stock, don't be blinded by earnings alone. Look at how much debt is behind it. 6. Look for businesses with economic moats. And what I finally analyze is whether the company has what I call an economic moat. That is, what protects it from its competitors. A good business needs something that makes it difficult to attack. A strong brand, high switching costs, patents, or a distribution network that's impossible to replicate. He doesn't invest in companies that compete tooth and nail on price every day. He prefers those that can raise prices without losing customers, because that indicates real power. When Warren bought See's Candies, it wasn't just for its chocolates. It was for its customer loyalty. They could raise the price and still have people buy. Why? Because they were buying more than candy. They were buying tradition, nostalgia, quality. That's the kind of business we're interested in. Companies with lasting competitive advantages that don't crumble with the first crisis or the entry of an aggressive competitor. Remember this. If a business has a moat, it has protection. And if it's well managed, that moat deepens over time. And that means long-term security and growth. I can give you all the formulas in the world, but if you don't have patience and discipline, you won't get far. The market is a machine designed to test your character. It will try to scare you with drops, confuse you with headlines, and tempt you with seemingly irresistible fads. I've bought stocks that have been stagnant for years, without moving a cent, and many people would have given up. But I knew what I had. I knew the value was growing inside, even if the price didn't reflect it yet. And one day, without warning, those stocks exploded. That's where discipline comes in. Not letting yourself be carried away by emotion. Not selling out of fear or buying out of euphoria. Understanding that real wealth doesn't come overnight, but with time, perseverance, and good decisions. Remember this. You don't need to do extraordinary things to get extraordinary results. You just have to avoid big mistakes and let time do its work. That's what Buffett has done his whole life. Buy well and wait. Which of these rules or indicators will you apply first to start building your financial freedom? We'll read your comments. If today's video was helpful to you, don't forget to give it a like and share it with your friends. See you in the next video.